Hi, everybody. In this series of videos, I'm going to be reviewing the major factors and points in the book Options as a Strategic Investment by Lawrence Mcmillan. I did pick up a copy of the third edition of the book, so the thoughts will be based on that third edition. There is a blog post at thetatraders.blog. There's a description down below this video. I'll be going over some of the thoughts that I see in it, and then we'll look at a few examples to show some of the strategies in place based on current actual options. For when I'm reading this book, I am essentially taking notes on the side on important bullet points, and then I put that in Google Keep just so I could keep it readily available for me. And then as I add more to the chapter, I'm just going to add more of my thoughts to it, and then I'll be posting that into the blog post. Um, this vlog is essentially going to be going over some of the notes that I put in the blog post. So let's get started. All right, so again, a blog post is in the description down below this video if you want to read along. Chapter 1 just has a lot of definitions for what's out of the money, in the money, what a call, what a put is. If you look through my YouTube channel, I have plenty of videos describing those things. But if you're not sure of a certain thing that I'm mentioning, feel free to leave a comment down below this video and then I'll address it. Chapter 2 is covered calls. He decides to do stuff on call writing first because calls usually make a little bit more sense than puts in general. So I said sell in the money covered calls to have more downside protection. A little bit bigger here. This is an interesting point. When I'm doing covered call strategies for futures, I'm essentially doing an in the money call by selling a out of the money put. But essentially, an in the money covered call is when a stock say at $100, you could sell the 95 call. That's going to pay a lot in premium. It gives you downside protection because if the stock goes down a little bit, you could still actually profit on the position. If you sell both in the money and at the money or out of the money for best of both worlds, which is an interesting point here. So if you have more than 100 shares, say you have 200 shares of stock, going out of the money doesn't give you as much downside protection. However, it could give you more overall returns because you would have some capital gains on that position as well. So let's look at a position with Apple, making this video in early April. And Apple's at $164.90. So what you could do is consider selling in the money call option. So let's say we're looking at the 145 strike price, which is about $20 less than the current price. And we're looking at about 47 days out. If you sell a 145 call, you would get at least 20.3 up to 22.1. Probably get somewhere in the middle, say around $21 in premium. So if you take the 145 and add, say, 21 in premium, you would get 166. And this will be our essentially profit would be the 166 minus the 164.90, which would be 110 in actual gains. However, if Apple decides to drop a little bit, not below that initial strike of the 145, but if it drops to say 160, 158, something like that, you would actually still profit in the position because you're taking in an enormous amount of premium, $21. So it's $2,100 in your pocket, and you do have that downside protection. The little extra that we have from 166 to 164.90 is an extra $110, which is essentially the intrinsic value that you can get from your position. Selling both in the money and out of the money covered calls could work as well. So if you look back at the option chain, let's say you're mildly bullish, but you're not necessarily sure it's going to be going up. You can sell a slightly out of the money call as well. Let's say you sell the 170 call. In this case, you would get about $510 in capital gains if called away. And you could take in 3.9 in premium, 420. So you probably get another $400 in premium there. If you happen to have 200 shares of stock, the book recommends as one possibility to sell one in the money at say 145, getting that enormous premium in case it drops a little bit, and then sell the other one at say 170, 175, because then you might possibly get some capital gains, and you do get a small amount of premium as well. One of the big ones that I notice is to find your return before you do the position. So you want to look at the option chain, look at the premium that you're going to take in, and then decide if you're happy with that particular situation before you enter the trade. Going back to that Apple example, if it's at 164.90 and you're selling the 145 call for $21 or so, you'd get about $110 in net premium, even if it drops a lot. So you could still get a good $100 out of that position with a lot of downside protection. If you are more bullish and you're selling that 170 call, you should be happy if it goes to say 200 or 220. Even though you're not getting that full gain, you get about a $510 gain in the actual capital gains, but you'd also be taking in another $400 in premium. So consider those situations when doing these trades before you actually enter them. Really key part that I don't see a lot of traders actually doing. Go with stocks you want to hold at least medium to long term. He doesn't give specific dates on this, but you should be happy with the stocks that you're doing these strategies with. And you don't necessarily want to pick the meme stocks where it could be big ups and downs in the market. And you're also very happy with the return that you get if you're called away. Be willing to sell covered calls below your cost basis. You will lock in a slight loss, but it is safer than the original call. So what that means is, let's say Apple, you bought 100 shares right now for 164.90. You sell, let's say, the 145 call to make another $2,100 in premium. And let's say Apple completely tumbles and it goes down to say 140. In this case, you would still be down a little bit because from 164 to 140, you're down about $2,500, but you took in $2,100, you would be about $400 down in that position. You can consider in the next covered call to sell one that maybe takes in $200 or $300 because in that case, you would be locking in a smaller loss than if you just held the stock and then hope that it goes up. Okay? You can also roll down part or all of the position if you'd like. So back to that case here, if you saw the 145 call and it starts dropping considerably, you could decide to buy back this option. It'll be worth less premium. So you could actually make a difference in how much premium you collected minus the premium that you bought it back for, and then sell a new covered call, maybe further out in time, another month or two, at an even lower strike possibly. Sell cover calls at different expirations is another way to go, especially with implied volatility being relatively low when you might start to position. Shorter term options in general give you more theta decay per day, but if you want to take advantage of some implied volatility changing, you can sell some longer dated ones as well and possibly stagger them out if you have more than 100 shares in a stock. It's unlikely to have a loss on very high prices and near the low of the stock when you sell a covered call in the money. So for the Apple example, if it drops to 145 minus a 164.90, you got a 19.9 drop. Divide that by the current share price, 164.90, and you're looking at a 12% drop in order to pretty much get near your break-even point. That's pretty rare for it to happen, especially for Apple. If you're doing this not during earnings, it's going to be a really low chance of it happening. Another way you can look into this is the expected move on Thinkorswim. Shows an expected move of plus or minus 14 or so. So 164.90 minus the 14, 150, which is still above where we're selling a possible covered call there. So in general, do this with relatively higher price stocks, and it's usually a safer, more conservative position. When a stock goes up, it's okay to roll up, even for a debit if you'd like. So for instance, let's say it's at 164.90, you sell the 145 call, and it goes up to say 180. In this case, the premiums would be a lot higher because you're really far in the money in that case. If you want to possibly lock in some capital gains, you could buy that back at a loss, sell a new covered call at a little bit of a higher strike price, and you could still get extra theta decay if you're extending it outward, and you also could get a better overall profit if it stays in that higher stock price. Some actions to take at or near expiration. If you're in the money, the optimal time is when the time value almost completely disappeared. So if you went back to the situation with the 145 call, you're waiting a long time and the premium went down to say one or two, that might be a viable time to actually get out of the position and then maybe sell a new call later on in the future. You want to find your return per day when you're doing these. So sometimes when you're selling these options, you could decay it at least 50% in less than 50% of the actual trading days that you're in the trade. So if you're gaining more per day by letting it theta decay in the initial part of your premiums, then it might be worth actually closing it and then starting a new position. So, for example, if you're selling 10 options, it might cost around $100 in commissions. This was in the early 90s. So commissions are a lot less now, or about 65 cents on Thinkorswim. So a little bit of the strategies are a bit different now compared to the older version of the book. If you're rolling a covered call, it usually earns more than letting it called away in a lot of cases when it costs money to buy the stock. Unfortunately, now it doesn't cost anything in most brokerages to buy a stock. So it's a little bit off now from early 90s to currently. General summary of what I wrote. Covered calls reduce the risk of owning stock because you're getting in that premium, right? A lot of people think that when you're just holding a stock and then you're doing something with options, options have to be riskier than just selling options with it, but that's actually completely false. If you're selling covered calls, you're reducing your upside, but you're actually making the trade more conservative and safer because you're taking in money during it. Writing in the money is more conservative in general than out of the money because the stock price could drop a little bit and you would still be possibly profitable because you're taking in a lot more premiums than out of the money. Out of the money is a little bit more aggressive because you kind of want the capital gains and you want the stock to go up, and you're also taking in less premium than in the money. Returns should be calculated before entering your trade, include your commissions and dividends. And that was the article summary notes that I took for chapters 1 and 2. So, in summary, the first two chapters of the book does give a very good foundation on selling covered calls. And covered calls, I think personally, is a really good strategy for beginners, especially if you have a lot of stock already and you already have capital gains. So you bought a stock at 30 and it's already at 50. It can be very viable to be selling covered calls at that 30, 35 strike price. They'll be in the money in that case because the stock's at 50, and then take in a lot of premium, essentially renting out the stock to somebody else. In a lot of cases, this is a very good foundation for selling different option strategies that we'll look at in the future of this book. But you could do perfectly well just selling covered calls on stocks that you already own for a long period of time if you want to get consistent income. Again, I'm the investing teacher, high school science teacher, teaching others how to invest. Keep watching the channel, like and subscribe it, and I'm going to be summarizing the rest of the book as I read through it. Probably do about a chapter every week or so. It's a very long book, so it's going to take a little bit of time to do the full series. But let me know any thoughts and comments down below this video, and I'll make sure to address it. Everyone have a good rest of the trading day, weekend.